Hello and welcome back to the FX Evolution trading course. Today we're going to be talking about types of orders in the market and when and how to use them. So here we have a brief summary of the different types of orders. We've got the market buy order, the market sell order, the buy limit order, the sell limit order, the buy stop order, and the sell stop order. Now generally I find that people have a very easy understanding of market buys and sells, but they get quite confused when it comes to buy limit, sell limit, buy stop, and sell stop. So let's look at each one in more detail. We'll start by taking a look at market orders, both buys and sells. So here we have an upward trending market. It's going up over time, and we may consider buying it at a price. Let's say at this price currently we want to buy into the market. We could do so by using a market buy order and be able to buy the zone straight away at whatever the market price is. It's important to note though that in the Forex market or any trading market, if we are trading live and we're using the market buy price, it could be different from the split second that we click the button to actually place the order and what the price we actually get is. Always make sure that we check economic news before entering market orders to make sure we're not entering at a market order time where potentially there's economic news. This can create what they call slippage, which basically is the difference in price from when you click to what you actually get. So always make sure to check economic news before placing any of the market orders. Here, of course, we're looking for an increase in price. So we choose to buy the market, and as it increases in price, we will profit from this trade. Let's now take a look at a market sell order. So again, we have an upward trending market. However, this time at the same price, we want to look at selling it. To sell the market means that we're looking for a decrease in price over time. So we want the price to come down over time. Let's now take a look at limit orders, specifically buy limit and sell limit orders. So again, we've got the upward trending market, but this time we don't want to buy it at market price, we want to buy it at a better price. So we still believe that the trade is going to continue going up over time, but we want to set what we call a buy limit order. The easiest way to remember it is if we're setting a limit, we want a better price than what is currently in the market. So if we set the buy limit, we're looking at the price to come down, hit our limit price, enter us into the market with the idea that then price will increase over time and we will profit from an upward trending market. So let's now look at sell limit orders. Here we have the same chart of an increasing market. What if we believed the market was going to increase a little bit further, but then it was going to come down, but we weren't going to be in the front of the charts at this period of time? We could place what we call a sell limit order. So this is when we'd be looking for price to make a new high, or in this case just a higher point, and then we'd be looking at profiting from the decrease in price after that point. So we place our sell limit order above current price with the idea that price would then come up to our sell limit, and then we can profit from the decrease in the currency or the stock at this point. So let's now take a look at stop orders and how they differ from limit orders and market orders. Buy stops and sell stops. Here we have the same example of an upward trending market. If we wanted to buy into the market at a higher point because it broke a critical zone, we couldn't do so with a market order or a limit order. We could, however, use a buy stop order to do this. So we'd be looking for a price higher than current price, usually because of a technical reason where price has broken out past a previous zone. So we can place our buy stop order above current price with the idea that price would then increase over time, and of course then would continue to increase over time after breaking past the critical zone. With a sell stop order, what we'll be looking at doing is placing the sell stop at a price below current price. So we'd be looking for price to come down, break below probably a support line or some other critical zone that we're looking at as technical analysts, and then we would sell stop the order, and then it would continue to go down into our favor. So we'd be looking for an increase or a decrease in this case of price over time, and for us to profit from that as traders. So to summarize, market buy orders are a buy at the current price. Market sell orders are sell at the current price. However, they do have the problem of it. Whenever we click it, we need to check that economic news and make sure that there's no current news out, because the price could differ if something big was happening in the market at that point from when we click and that fraction of a millisecond to when we're executed. We've also got buy limits, which is a pending order that buys at a level lower than the current price. And then we've got sell limits, which is a pending order that sells at a level higher than the current price. So we usually place limits or stops when we're not going to be in front of the charts at all points in time. We may be looking at a technical trade, but we're not able to be in charts 24/7, so we can place these orders in advance of something happening while we sleep or while we're away from the charts. Then we've got the buy stop, which is a pending order that buys at a level higher than the current price, and the sell stop, which is a pending order that sells at a level lower than the current price. That's all for today's video, and we'll see you in the next video.